Hello traders, Gary Wagner here. It is 12:20 in Honolulu, 6:20 in New York on Thursday, 9th day of June 2022, and this is the daily report for gold and silver. Gold did decline in trading today, trading down $5.80 in New York at $1,850.70. Currently, we have gold futures at $1,850.20. That's $2.60 below the close in New York. On closer inspection, today's decline was 100%, the end result of dollar strength. The dollar gained approximately 0.75%, is currently trading at 103.28. And as we just said, the decline in gold was approximately 0.3%. Unfortunately, it was today's low that really concerned us, as it did stomp us out of the trade we put on yesterday. We went long at $1,855 and were stopped out at $1,843, sustaining a loss of $12 per ounce. Obviously, we had placed our stop too tight. Our assumption was that we had noticed a series of higher lows coming into the trade itself, and therefore it was our belief incorrectly that any move in gold, while under pressure, would trade above this particular trend line. It did not. As you know, many analysts, including myself, have for quite a while maintained that the Federal Reserve cannot in any way curtail inflationary pressures due to their root causes. However, today it was hedge fund founder David Einhorn that put it incredibly succinctly in a speech that he made in front of a hedge fund conference. During his speech, he made a very interesting and profound statement as to why he believes that gold will begin to rise amid the current environment of rising prices that he says the Federal Reserve cannot curtail or reduce. And that assumption is clearly backed up by the forecast for tomorrow's CPI report, which is expected to show a large increase in inflation, 0.7%. That is twice the gain that we witnessed in April when inflationary pressures came in at 8.3%. That would take the CPI index year over year from 8.3 to 8.4%, clearly showing that inflation continues to be persistent as well as hot. If in fact the forecast for tomorrow's CPI report is correct and we get an uptick in inflationary pressures, we can expect some extreme volatility. However, we have also noted that there's a push-pull or double-edged sword effect to inflation. While inflationary pressures is a solid bullish component or undertone for gold, the thought of the Federal Reserve becoming more aggressive with their monetary policy has the opposite effect. Therefore, we could easily see extreme volatility tomorrow. So our strategy is to let the report come out, let the dust settle, so to speak, and if we see that it is taking gold higher and a solid rally is ensuing, we will re-enter from the long side. If the opposite reaction occurs, we will remain sidelined or possibly enter a short position. This has been Gary Wagner wishing you, as always, good trading. We will talk to you tomorrow for the weekly wrap-up and review. Bye-bye.